Good afternoon, everybody. Welcome to the May Business Vision webinar. Thank you for joining me this afternoon. And today we're going to be looking through key numbers for small and medium businesses, which hopefully is everybody on the line today. For those who don't know us, we're Business Vision accountants in Plymouth. I'm Mark Lawson, the MD, and we specialise in helping businesses, particularly small and medium businesses, grow their profits and also grow cash and hopefully spend less time and have more fun doing that in the process. So today's subject is quite a big area. I'm only going to be able to get a certain amount of information in 45 minutes, but I will at the end go through methods where you can extend your knowledge and information about this subject, hopefully having piqued your interest in what can be a very dry subject normally. Okay, so we'll start with the level of financial data that you typically need to look at. And surprisingly, coming from an accountant, I'm going to start listing the problems with annual accounts. And this is probably your first port of call for information, but I think annual accounts prepared by accountants is fundamentally flawed. One of the reasons is that annual accounts by definition are for a year, and that length of time is decided by people other than the business. It's decided by the government at Companies House, it's decided by HMRC in the tax office. They only want to see your information yearly, and that forces you to sort of work on an annual cycle. But there's no logic in having figures made available to you governed by how long it takes the Earth to go around the sun. So there needs to be a different view on that. The other problem is when you do get the annual accounts, typically there are 2 years. There's the year that you're looking at, the current year, and then there will be the previous year's figures that were done last year next to those as what's called a comparative. So you can see this year versus last year. Trouble with that is comparing one set of figures with 1 year doesn't really allow you to know what's going on. It doesn't give you enough length of time, enough sets of data to work out what the trends are and where things are going. If this year looks exceptionally low and last year looks high for, let's say, sales, it's difficult to say whether this year is a blip or whether actually, if all the previous 5 years have gradually been dropping, that there is a fundamental decline. So we'll look at later what you do need, but I think up to 5 years information is easily presentable and should be what's in front of you rather than 2 years in the annual accounts. The other big problem, certainly up until fairly recently, is that those accounts tend to get produced for business owners very late in the day. Typically, accounts might be done 3-4 months after the year end. Well, in the current climate, an awful lot will have happened in those 3 or 4 months, and by the time business owners get those accounts, they're irrelevant. So they will not pay as much attention to them as they should. And I've seen some accountants produce accounts, right at the end of the possible period, which is usually 9 months for getting information into government bodies. So 9 months is way too late to be getting information, which means they're only being prepared just for government bodies. There's no great use to the business owner. So they need to be available within a month or two maximum of year end. And increasingly, with the benefit of cloud accounting and online bookkeeping, that's certainly possible. It just requires the accountants to start changing the way they think. In our particular practice, we normally try and turn accounts around within 2 weeks, and we encourage business owners to get the information in within 3 to 4 weeks of the year end. And that's typically very possible their end, and it's very possible our end, which means we can have a meeting and go through all the figures within about 6 weeks, 7 weeks of the year end. The other problem is accounts. If you've looked at accounts, particularly those for limited companies, is they're not designed for small and medium businesses. They're designed for large PLCs, and they're designed for the city stockbrokers to review to see how share prices might change. So there is a huge amount of data that needs to be reviewed and included in the accounts where appropriate. If you went through everything for businesses, it would be about a book's worth. For small businesses, the bit that does get in eventually is quite small, but it still requires everything in that book to be reviewed to see whether it's relevant. And the layout in the accounts is very much defined by a set of rules for PLCs. It's certainly not designed to be understandable. It's certainly not designed to be useful. And the other problem with accounts, which hopefully we'll get over today, is that they're full of jargon, they're full of terms that no normal business owner will understand and shouldn't be expected to. They should be presented in plain English so that business owners can understand and get use from them. So I think there's some fundamental problems there with business accounts, which is why once the business owner gets the accounts, they typically end up here in the bottom drawer very quickly without even having been looked at, and they stay there for a few months until the bank manager asks to see them. So hopefully today we can give you some information that will allow you to understand a bit more about what's going on in your figures and what use you can get out of them. And the problem with accounts going in the bottom drawer and not being looked at is because business owners don't see any great value in them, and that's not the business owner's fault, that's accountants' faults, it's bookkeepers and bank managers' faults in having figures that aren't really understandable and don't portray any great value. Okay, so what information should we look at? Well, I believe that the information that you and your team need to review is daily, weekly KPIs. KPIs is an important factor. It stands for key performance indicators. It's the very lowest level of what runs the business, and I'll go into those in a bit more detail later if you're not aware of what those mean. So every day, or at least every week, your team should be looking at the specific numbers that drive the business for their particular area of involvement and know how the business is doing for those particular numbers. And the reason for that is if you leave it any longer, what tends to happen with human people is that they ignore what they're trying to do with their particular numbers until it gets very late in the cycle, and then they have a mad rush around trying to fix those figures, but obviously by then it's too late. So if your team are going to run around trying to fix the KPIs towards the end of the cycle, it would make sense to have a short cycle, so at least they're rushing around more frequently. If it's a monthly sales target, for example, the salesperson will typically start to panic towards the middle of week 4, and if they're under target by that stage, there's nothing they can do about it. So if they're looking at it weekly, at least they're going to be panicking at the middle of each week, which should mean they get further forward. So that's daily or weekly. Monthly management accounts comes from the bookkeeping system, and increasingly accountants are able to prepare those these days so that they're very accurate, because part of the problem with business owners producing monthly figures is they don't tend to be that accurate, unfortunately, and therefore they don't tend to stack up when the end of year figures are produced. So monthly figures can be produced. They need to be 95 to 99% accurate compared to the end of year figures produced by accountants. So they do need to have normal bookkeeping and accountancy adjustments in there. And then there's obviously an annual financial performance review, and I've deliberately used that phrase rather than annual accounts for the reasons that I've said before. I don't think annual accounts do the job. An annual financial performance review would be more useful information, and in particular it would probably include a 5-year analysis of where the business is and where it's been, and possibly things like benchmarking, comparing those figures to other people in the industry, and that's very easy to do these days. So just to recap, daily, weekly KPIs needs to be looked at by the whole team on a regular basis. Then monthly management accounts typically would be looked at by leadership teams, that's the people running the business near the top, maybe managers, but certainly business owners, managing directors. And then the annual financial performance review would just be looked at by the managing director and the shareholders owners if they're different. Typically with small business that will be the same set of people. So all of that is what we need to be looking at, but none of it is particularly useful if we don't have a business plan. So we need to know where we're trying to get to know whether the figures we're looking at are of any use and whether we're getting where we need to get to. And as they said in Alice in Wonderland, I think it was the Mad Hatter, if you don't know where you're going, then any road will get you there. So clearly in business, we need to know where we're going, and we need to know which road we need to be going down in order to see whether we're going to get there. in the past, annual accounts have been the only thing business owners look at. And the big problem with that is that they don't know whether they're on track or not until the end of the year. And an awful lot can have happened in a year. So they do the whole thing again, and then they wait a year and see whether they're on track by the end of next year. With regular information, a business will know whether they're on track daily or weekly maximum. So there needs to be a roadmap. And we call that a business plan. So let's just go through some of the stages that you would look at when you're creating a business plan. Again, this is a subject for a whole nother webinar or seminar, but I'll touch on the key bits. Some of you probably are familiar with planning, although it has been said that most business owners spend more time planning holidays than they do planning their business, which is a bit worrying. So stage one with the business plan is creating broad 1 to 3 year aims. So not hugely specific, we'll come on to that later, but just some basic numbers that would keep the business owner happy. And I've deliberately started it possibly the wrong way round to the way most people look at it. Most people start a business plan going, what shall our sales be? And then they gradually work down and see what they're going to end up with. I would start the other way round. I'd reverse it, and I'd start with, what does the business owner want to get out of the business? What do they want going into their personal bank account to live off? We call that drawings, but it will obviously be profits or salary or dividends depending on the nature of the business. So that's the starting point. The whole point of running a business is to ultimately do something for the personal life of the business owners. It's a means to an end. It's not a means in itself. So we need to know what's the business owner want out of it in order to say that the business is working for them. Once they know that, they can do some calculations to allow for things like tax, money that's going to be left in the business for expansion, etc. And that would tell them what profit they need to make in order to allow them to take those levels of money out. And once we know the profit, then we can start to budget for expenses. And once we've done that, we can then get to a sales figure. So the sales figure pretty much comes last because that's the ultimate target in order to drive the rest of the figures we've talked about there. So a slightly different way than most businesses would typically look at doing. And then still under stage one, we would then look at some of the other areas. Just as important, if not more important, is what cash are we going to need in the business? What cash are we going to be left with in the business? Is it sufficient? And throughout this session, I'll be talking about cash, but I mean everything in cash, bank, deposits, savings accounts, etc. All forms of immediately available money. So we need to know what the cash is looking like, and that's one of the big things that should happen with plans, is we work out whether what we're aiming to do is going to cause us any cash problems, and it often will. What assets are we going to need? If we're going to add 20% to our sales, are we going to need new premises? Are we going to need new vehicles? Are we going to need new equipment? If so, that then affects the cash back again. So we need to know what assets we need. We need to know what size team we need. Again, if we're expanding, then that might need to bring on more people, more recruitment costs, time to train them and bed them in. And as I said before, cash, the opposite side to that is borrowing. If the business plan doesn't produce enough cash, and that doesn't mean it's a bad business plan. Many successful businesses have borrowed huge amounts on their plan and been successful. But obviously, what does the plan say we need to borrow? And let's go and make sure we have that funding available before we start out. Let's not get to a point where we're running out of money and then start chasing around trying to get some money in from lenders and find that it's going to take 2 or 3 months, or worse, that they're not even prepared to do it. So we need to know that up front. So that stage one is typically 1 to 3 year plan, minimum 1 year, but I think it makes sense to extend that to 2 or 3 years at the same time, where year 2 and 3 will be slightly woollier than year 1. Now, a note of caution at this stage is that a lot of people go, what's the point of doing a business plan? Because it will never be exactly what I've said. It will change almost immediately. I plan for £10,000 sales a week, and the first week we get 8. So therefore, what's the point? Because it's going to be irrelevant. And I would put another view forward on that, which is if you wanted to travel from, let's say, Plymouth to London, you wouldn't not work out how that's going to go just because you think that the journey isn't going to go exactly how you want it to do. The whole point is that by knowing what you think should happen, you can basically take view and take stock regularly, see where you are and make adjustments. And that's exactly what you do when you're travelling, is you don't get in a car and then wait 3.5 hours and see if you're in London and just deny the use of a road map because of that. You basically check after about 10-15 minutes, you look at the road signs to make sure you're on track. You look at the gauges on your dashboard to see whether that's telling you that there are no problems, and you look at the clock to make sure that you're actually still where you're supposed to be at the appropriate time. And if you're not, you can then basically make alternative actions, ring ahead to where you're going, or maybe speed up a little bit or take a different journey, etc. So I say the fact that a plan will never actually be exactly what you get shouldn't be a reason not to do it. Okay, so within the business plan specifically will be all the details. So there'll be details of marketing strategy, sales strategy, operational strategy, but financially, given that we're talking about key numbers today, financially the business plan should include three things, and one of the three tend to get missed. The obvious ones are profit and loss forecast, so that's forecasting your profit. Then there's a balance sheet forecast, and we'll talk about balance sheets a bit later. And then finally, which is the bit that most people don't tend to do or get confused between cash flow and profit forecast, is they don't do the cash flow forecast. And the last one is the most important, because businesses don't tend to go bust through items on the balance sheet or profit and loss. They go bust through lack of cash. That is the definition of going bust. So cash flow's got to be in there, and there is software these days that will allow accountants to prepare very comprehensive three-part business plans with those three areas in there. And then the third stage is to basically go down to the very low level, which I talked about, which is key performance indicators. And key performance indicators are drivers of the plan. They're the very low-level things that have to be done to get the big picture working. So it's the day-to-day nitty-gritty that each member of the team has to do, and it will vary from different members to different members. And knowing the KPI and the target for the KPI will then allow you to understand what actions need to be taken by that individual, and from their point of view it will allow them to understand what doing a successful job will be, because it will be achieving their KPIs. I'll just go through a little example of that just in case that's not crystal clear, because it's not an easy concept unless you're doing it already. So if we just look at a business where part of their plan says we want to achieve 10,000 sales per month on the internet. There's other areas going on as well, but there will be a team member or several team members assigned to internet sales. Maybe they haven't been as much as they could have been in the past. So the plan says that we basically need 100 orders at an ATV, which means average transaction value of £100. So to get 10,000 per month, the business plan says we need 100 sales of £100 average value each time. That gets us 10,000. But we drill down even further. We know that to get internet sales, we will need to get people visiting the website and making inquiries. So we've worked out that we will need 1,000 inquiries, and 10% of those inquiries will result in a sale. That's called a conversion rate. We're converting 10% of the 1,000 people to actually make a sale, which gets us the 100 orders. And even going further back than that, we know that in order to get an inquiry on the website, we need visits. So we therefore need 20,000 people visiting the website at a 5% conversion rate, i.e. 5% of those people make an inquiry. So we've now got different levels of how to achieve 10,000 internet sales per month. Typically businesses will stop at the first level and just go, we need 10,000 internet sales per month, but the business owners and the people in charge of getting that, the sales people, marketing people, won't really know what to do. All they'll do is look at the figures each week and realise that they're not getting there, but they won't know what to do. Whereas this way they can identify each particular area, and by knowing the numbers daily or weekly, they can start to see which area is not working. And obviously different people will be in charge of different areas. So line one, it might be the salesperson who's in charge of getting the orders, but it's probably the marketing department who will decide on pricing, which will get the £100 transaction value. Line two, getting the inquiries, might be to do with the marketing team, but it also has something to do with the web designer and the relationship between the two. The marketing department will have to discuss with the web designer how to get people to do inquiries on the website once they get there. And that's an important area, a lot of work to be done on that. And then the last line, getting 20,000 visits, is probably a combination of the web designer and the SEO team, although they might be the same people in small businesses. So each of those numbers will have different things to do to get them, and possibly different people, different team members in charge of that. So let's look at what numbers we need to look at, and more importantly, how we're going to get them, what they mean. I say this is looking at typically financial figures. It is a big area, and I'm going to touch on just a few little areas, but they're the most important areas in my view. So even if you do no further training or research in this, there will be enough here to hopefully guide your business forward in doing a bit more than it's doing already. So let's start with the obvious one. Profit and loss account. Most businesses tend to look at that, although they don't look at every aspect of it. And if you look at the accounts, I've summarised the key headings, although most accounts will obviously have those headings broken down into further sections. But we've got sales, then the cost of sales, which is typically the cost of things that directly get the sales. So that will be, for most businesses, the cost of materials and the cost of direct labour. Direct labour meaning that the people you pay are directly involved in doing the sales. So that will be the production staff, etc. It won't be the admin staff. And the difference between those first two figures, sales and cost of sales, gives us what we call a gross profit. So in this case, that's £200,000. And then off that comes all the overheads, which will be things like rent, rates, accountancy fees. And once that comes off, we're left with net profit. Net profit is usually before tax, and it's also before a few other bits. Now, in my experience, where most business owners and team members tend to concentrate is on the sales figure at the top. So they're monitoring the sales figure, and if I quiz business owners, they tend to be able to tell me two figures almost immediately from their financial status, and that is their sales figure by day or by week or by month, and the bank balance. The trouble with the sales figure is it's not a great indicator of a successful business. Just getting more sales does not guarantee in any way, shape or form more success. And if it did, then clearly people like Woolworths and BHS would not be going in, bust, because they have far more sales than most of us have, probably all of us, and yet still don't manage to succeed. So there are more important figures to look at than sales. It's true you need sales to make a profit, but it's also true that just having sales doesn't guarantee success at all. And in fact, in some businesses, going for more sales can actually compound problems and cause bankruptcy. So let's look at those in a bit more detail. And the figure I would say that you look at first of all, probably instead of sales, is your gross profit and the gross profit percentage. And I've highlighted that calculation there in red. And the reason for that is gross profit is an expression of quality of profit rather than quantity, which is what sales does. You need a good gross profit percentage, so therefore that's a figure you need to measure on a regular basis. It's achieved by dividing your gross profit figure, the 200,000 in this case, by the sales figure, and that gives us a figure of 40%. Now, the target figure you're looking at will vary. So what's the right figure for you to be aiming for? Well, firstly, I would say the right figure is the figure that you've come up with in your plan that we talked about earlier. It's also how does it compare to the figures you've had in your previous 4 years, which will come from your 5-year review at the end of the year. So is that going up, going down? Is it on track for your business plan for the current year? And probably I would include looking at what do your competitors do. And it's quite easy to get the numbers for competitors. You'd be surprised. We can do benchmarking of businesses very easily. So if you're a plumber, we can tell you on average what other plumbers in the UK are doing for a gross profit and see whether you're doing better or worse. And we can even break that down by size of business and location so that you don't think that the figure's higher than yours because they're all in London earning a fortune. So that's the figure, and that's the sort of targets to look for. And I think that's a more sensible place to look than the sales figure. A word of warning with gross profit is if you're looking at your accounts, particularly if they're not prepared by you but prepared by a bookkeeper or accountant, just watch where they're putting the labour costs. What they should be doing is putting the direct labour at the top in the cost of sales, so it affects the gross profit, but the admin labour and possibly salesman, marketing team, they all go in expenses, overheads. So make sure they've split them, because if they don't, then you'll get a distorted gross profit percentage figure. I'd also watch out for what we call activity costs, which are typically overheads. They're in the expenses heading in the accounts, but they are costs that go up and down with sales. So an example of that in some businesses might be motoring. So if you're a manufacturing company and you deliver all your product, if your sales double, it's quite likely your motoring will nearly double because you need to travel more. Telephone might be one. If you're in a telecentre business, then obviously the more work you do, the more telephone costs you're going to have. But the accountant will probably show that in overheads, and so on. And the reason I say to look out for those is because technically they also affect your gross profit. So if your sales double, then those costs will double as well. So it doesn't make much sense including them in overheads, in my view, or at least be aware that if your sales is going to rise, so will those costs, and take that into account in your costings. And the other thing, very, very briefly, because this is something I go on about quite a lot at pricing seminars, is just be aware of basing your price and your pricing structure around the cost in your accounts. If anybody's doing that already and can't think why on earth I would warn them against that, then do contact me at the end of this. I'll give you some contact details and I'll go through it in more detail with a bit more time available. But the basic reason is that when people buy off you, they are not interested to one degree at all as to how much it costs you to do what you're doing. What they're interested in is what they get at the end of what you do. So if I'm buying a kitchen from somebody, I'm only interested in what that kitchen is going to be like and looks like and how it performs. I'm certainly not interested in how much it costs the kitchen guy to pay to get the materials and the labour. It's irrelevant from my point of view. It is important in terms of working out a profit, but it's not important or even valid in working out your pricing structure. So if you think that's a load of nonsense, I'll be happy to go through that on a separate occasion. It's not for today's session, but it is something to be aware of. Okay, I did say that we'd look at a couple of figures that you don't see in your accounts, and one of those that you're not going to see in there is what we call the owner's salary adjustment. And what this means is that in most businesses there's no figure in the accounts, or if there is a figure, it's not usually a valid figure for what the business owner or owners get paid. And there's many reasons for that. One is that in sole traders and partnerships, the accounts simply shouldn't show owners' drawings, so their wages, if you want to call it that, are not shown in the profit and loss at all. In companies, there may be salaries, but those salaries are typically low for tax reasons, and things like dividends are shown outside the profit and loss. So you might be looking at a profit and loss account, and there may be very little in the way of business owners' salary or remuneration or pay. So I always suggest that mentally, or better still, actually in practice, the accounts are rephrased and restated to include an owner's salary adjustment. And that needs to take into account that if it's the owner, the people at the top, usually, although not always, they are going to be the top paid people. You know, they're managing directors, so they should be getting paid managing directors' salaries, even though they might be working on the tools or doing other jobs as well. And in my experience, those owners typically do longer hours than employees would. And I would usually argue that they often have the equivalent of 2 jobs. They're working 60 plus hours a week, and they often will only have 2 weeks holiday a year, which really, compare that to what a salary would be for anybody else, that's 2 jobs. So they need to work out a figure and go, well, if somebody in my position would earn 40,000 working somewhere else, and I'm working twice as hard, then really I should be getting 80,000. Doesn't mean they have to get paid 80,000, but they need to know that that's what the accounts should cover. And that's the figure that would go into the accounts as an adjustment. And most business owners miss that, and therefore when they look at a set of accounts and look at the figures, they tend to look at it and go, yes, the business is doing well, but not necessarily if you take the owner's salary adjustment into account. It's quite easy to kid yourself that the business is doing well, but I would argue, you can in many cases go and work for somebody else and actually have far less stress and earn more money. So let's just look at our accounts and see how that would be affected. So basically, if in our last example we had £140,000 expenses here, if the business owner thought that they actually are worth 80,000 because they should get 40,000 salary anywhere else and they're doing twice as many hours as everybody else, then we really need to add mentally or physically another £80,000 into those overheads. And if we did that on the example I just mentioned, that would actually take the previous profit of 60 into a £20,000 loss. So I think that's essential for business owners to at least be aware of, but I would suggest they go further and actually put some numbers into their accounts. Just a side note, when we talked about jargon in accounts, you can see that that figure at the bottom, which is the loss, now has brackets around it. And some people may know, but some don't, that brackets round figures in accounts means negative. So most accountants and bookkeepers don't put minus signs, they put brackets. Okay, the other thing that doesn't tend to be shown in accounts is discounts. And again, I think this is important because discounts can be quite a big figure in many businesses. Let's just say, for example, that the brief profit and loss I just showed you, the business owner there typically discounted every job he was going to do by 10%. 10% seems to be the figure everybody's prepared to give away because they think it doesn't make much difference, and it's also a nice, easy figure to calculate. But if we go back to the previous example, if the business had discounted everything by 10%, then really their sales should have been 555. And what they're really doing is increasing their overheads by £55,000 worth of discount. It is a cost, but because accountants and bookkeepers and business owners show their sales net of discounts, because they aren't recording it anywhere typically, you won't see that in the accounts. And I would always argue that the accounts should be restated to look like this. So you can still see the £60,000 profit there, but you can also see that you've given away £55,000 worth of overheads in discount. And I think if business owners see the size of that figure in their overheads, they would tend to do a lot more about it rather than just discounting and then forgetting it ever happened. It might not be that easy to calculate discount in small businesses. Obviously, if you've got a recommended retail price or whatever, it can easily be calculated. But I would always suggest that business owners should try and be honest with themselves and just say, what should that sale have been if I hadn't discounted, if I'd gone for the full figure? And just see what that means in terms of the sales that are being given away. And the big problem with discount is, as you can see there, that giving away £55,000 worth of sales on discount doesn't change any of the other costs. The cost of sales, the labour and materials, is still the same. You still have to do those work, and the expenses are going to be the same. So that £55,000 effectively dropped straight to the bottom line. And if they hadn't done that discount, then that profit in the example there would have been £115,000, nearly double. The business owner might argue, well, I had to do that, although I would debate that strongly, but even if they see the figures, it means that it's slightly more in front of them and something to do about than if they don't see it at all and forget about it. It can be a big overhead, and given that business owners tend to moan about overheads that are a lot smaller than that, I think they should be looking at discounts. And just as a side issue, we talk about this at pricing seminars, but just to ram that home, in that particular example where there's a 40% gross profit, a 10% discount, which is usually given away to get more sales, would need the business owner to get another 33%, i.e. another third extra sales, just to get back to the original profit. So there's no point giving 10% away in this example unless the business owner is sure the effect of that is to get at least another third sales, and I would argue it probably won't. And similarly, if you look at the reverse, which is a price increase, a 10% price increase at 40% gross profit, the business owner could afford to lose 20% of the sales. So they could afford to lose 1 in 5 of the sales they would have had, and they'd still be making the same profit. But clearly, they're only working about 80% of the time they had to work before. So different subject for another day, but do be aware of how discounts and price increases can dramatically affect negatively or positively the business profits. Okay, so that's a brief look at a couple of things to look at in profit and loss. I'm now going to look at the dreaded balance sheet. And I say dreaded because most business owners don't read balance sheets because it's less understandable and more complicated, or they think it is, than any other set of figures they look at. So I often ask business owners to bring in their accounts or their management accounts, and they'll only turn up with a profit and loss account. And I say, what about the rest of it? And they say, that's it. Didn't bring the balance sheet because it's not really that important, is it? Well, it is, and I'll explain why. So let's look at what's in a balance sheet typically. There's usually 4 headings, although again they can be broken down into lots of subheadings. And those 4 headings are fixed assets, current assets. Assets in this scheme of things is what we think it means. It's basically positives. So if it was looking at it from a personal wealth point of view, it would be our bank balances, it would be our investments, it would be our house, it would be our car. It's exactly the same with businesses. So assets are positive things that we own, and then you've got current liabilities and long-term liabilities. Liabilities being the opposite of assets, they're things we owe, things that we're going to have to pay back. So that would be loans, overdraft, suppliers we owe, the VAT man, the tax man, etc., etc. So there's only really 2 categories, assets and liabilities. Assets are positive, liabilities are negative, but you'll see that we've actually broken them down into 2 bits for each. And one of those bits is called current. And all that means is that's the bit that will actually reach the bank or leave the bank within 12 months. So current assets would include things like stock, and that will reach the bank normally in 12 months because it will be sold and the money will be paid for it and it will go into the bank within 12 months. Money owing from customers hopefully will reach the bank within 12 months. And in current liabilities will be things like tax, which obviously will have to be paid within 12 months, PAYE, which will usually have to be paid within 12 months, loans, which may have to be paid within 12 months. So current just means short term, and the definition is anything less than a month to reach the bank account. A couple of things with the balance sheet. So the final figure at the bottom, which is the net of all those 4 figures at the top. So if you take the assets and take off the liabilities, you're left with 20,000. That broadly means that's what the business owner will get if the business is wound up. But it won't technically be exactly that figure for 2 reasons. There are several others, but the big ones are that in fixed assets may be things like computers and property. Well, accountants will show those at original cost usually. So if the property's gone up in value, that won't be reflected in that £200,000 figure. Similarly, accountants will depreciate equipment, computer equipment, etc., and they use standard round figures for that. It won't reflect what actually has happened. So you might find that if the accounts say there's £20,000 worth of computer equipment, it might only be worth £2,000. So the fixed assets aren't always going to be spot on. And the other reason that the figures there won't necessarily be real is most accounts don't show the value of goodwill. That's the extra amount of money you can get from selling your business above and beyond the actual assets and liabilities, and that can be a huge figure. So bear that in mind. It's just because it says there that the business owner is going to get £20,000 when the business stops, it could be a lot more or a lot less, and you need to do a separate exercise to work that out accurately. So let's look at one of the key numbers here on balance sheets, and I think this is probably the most important number, certainly in the balance sheet, maybe completely, that you need to look at, and it's called the current ratio, and it's effectively the relationship between current assets and current liabilities, because that's saying how does what we have to pay out in the next 12 months compare to what's going to reach our bank within the 12 months. And clearly, if what you've got to pay out is higher than what's coming in, then potentially there's a problem. In the same way, in private lives, if you're getting £2,000 salary in, but your outgoings are £2,500 short term, you're going to have a cash flow issue. Doesn't mean you can't survive if one figure is bigger than the other, but you certainly need to know what the number is, and you need to know which way it's going as a trend. So the number is calculated by the current assets divided by the current liabilities. So in this case, it's 50%, and that's often expressed as 0.5. So current assets divided by current liabilities, 50% or 0.5, it's the same measurement, whichever you feel more comfortable with. And a target for that figure typically will be between 1 and 2. And this is a number very much that banks will look at when they look at your accounts. And if you actually send your accounts into Companies House, it will directly impact your credit rating, because this number tells everybody whether you can survive and whether you are able to pay your way. So you need to know, is your figure between 1 and 2? If it's below 1, doesn't mean you are going to go bankrupt, but it means that the chances are higher. But you also need to look at which direction is it going. If the measurement's 0.5, but it's going up every month, then it means eventually you're going to get to where you need to get to. If it's 0.5 and it's been going down every month, then that could well be a good indicator that you will go bankrupt. There are ways around it, but knowing the figure and then making adjustments within the business are ways to move forward. So I think every business owner should have that measurement, certainly annually, but I think even more regularly, weekly or monthly. As I say, it's a huge figure as an indicator of whether the business can survive. And you can't tell that from the profit and loss account, because there are some businesses that might have £200,000 profit, but if that profit isn't going to help them pay the bills, which it may not, then there is an issue. The other measurement, which is very much associated with that, is instead of showing all the current assets, you only include the money in the bank and what I call receivables. You and your accountant might call it trade debtors, money owed from customers. So you only include what's going to come in very quickly, which is money already in the bank and money going to come from customers. Most customers should pay 60 to 90 days. And you compare that with current liabilities. So it's the same method, but clearly this is going to be a lower figure because we might be excluding other current assets. And the target there is anywhere between 0.6 and 1.5. So I would do that as well. And current ratio and quick ratio, as I say, will be very much the first thing bank managers look at. They won't look at your profit and loss to start with, they'll look at your current ratio. And the reason why they're interested in that and not necessarily profit is profit isn't necessarily a guarantee of cash. Your profit may be used to fund business owners' money to a greater extent. So if you're making 100 grand profit, but the business owner's taking out 150, that business will go bust. If the business is making 100 grand, but it needs to buy 150 grams worth of assets every year, premises and so on to survive, it will go bust. So there's lots of things the balance sheet will tell you that a profit and loss won't. And that's why accountants and bank managers will look at it. The third figure, which I don't particularly worry about if this isn't top of your agenda because it is a bit complicated, but you can certainly get accountants or bookkeepers to tell you this, is return on investment, which basically says how much money you're getting back for all the money you've got tied up in your business. And that's a logical thing to work out, because if your business is worth, let's say, £100,000, if you sold it today and you could invest that at 5%, if your profit's less than 5%, then I would suggest you sell it immediately and go and invest it, because it's making less money than just sitting around doing nothing and putting it into a bank account. So it is an important figure. It's basically saying how well does the business perform with all the money it's got tied up, and that how well is a profit figure. Clearly, from what I've said earlier, it should be profit after owner's salary adjustment. Okay, and finally, the last thing I would suggest you look at is a cash statement, which again, most accountants don't produce. We do as a matter of course, and we call it a where did the money go statement, because many business owners ask us when they see the accounts, if I've made £60,000 profit, where is it? And the answer is there's no guarantee that your profit's going to be in the bank account. And I've put here some examples of why it won't be. So for example, out of the profit you will have had to pay tax. Out of the profit you will have had to pay money to the business owner. Out of the profit you may have had to buy vans and other fixed assets. And also, even though you've made the profit, you may not have yet received that from your customers. So in that example, the business has made £60,000 profit, but the actual money in the bank was £50,000 down. And that's why businesses can go bust, even though they've got a good profit. It's because it's where the money goes after they've made the profit. Profit isn't a guarantee of money in the bank. So quite an important statement. Okay, hopefully that's given you a very quick insight into some of the numbers, and I'm very aware that this is scratching the surface, but hopefully there's enough there to get your teeth into. Just very quickly want to go through your action plan, what you need to do. I would suggest that if those bits of information sound sensible and present things in a logical, plain English way, then you might want some more detailed financial training. We have a financial training program that is open to as many of you and your team as you want. It's a half-day session, and that will go into a case study where we produce figures for a dummy business and then get everybody to review it, see what they think, and then we go into all the numbers in great detail and analyse it. Very, very powerful. When we've done that training, it's got rave reviews from business owners. So if you're interested in that, I'll give you some contact details in a minute. I would suggest, if you haven't got one already, that you start a business plan in the way we've explained. I would think you also need to start some number reviews, weekly, monthly, yearly, so you need to start looking at these numbers, certainly the ones we've talked about today, but probably a few others. I think you need to make sure that your accountant or your bookkeeper at the end of the year is producing a financial performance review, maybe some benchmarking analysis, i.e. useful accounts, rather than just the normal ones you get for company's house purposes or taxman purposes. I think you need to produce a where did the money go statement, and again, a good accountant can produce that for you. Again, I would suggest that's monthly. And I'd also look at cloud management systems. These days, there are some exceptional cloud bookkeeping and accounting systems that will allow you to do most of what we've talked about. Xero particularly, which is our preferred favourite, the Xero bookkeeping system. Most of our clients use, and it's very, very powerful. So if you're not using Xero and think you should be, again, contact me. I'll be happy to go through this. Future events, we do regular seminars and these webinars. So the next live seminar in Plymouth is headed Achieve Record Results and Avoid Making Costly Mistakes. That's on the 15th of June. And that's all about how to keep making errors and having problems with work, customers, which we all have, but it doesn't make sense to continue having them and make the same mistakes over and over again. And it costs businesses a lot of money and a lot of heartache with customers leaving or disputing stuff. So we're going to go into a very sensible, quick and easy way of avoiding all of that. And then the next webinar, 20th of July, that's all about newsletters. That's there, I think, falling into history really, newsletters. Not so many people produce them, but they are a great marketing tool. But the reason most people don't use them anymore is because they don't work. And that's not because newsletters are bad, it's because the way they're produced usually are. So we're going to go through how you produce great newsletters and use them to gain client numbers. So if you can get to that one, be good. I did say that if you've got any questions or want a bit more information or just have any points of interest at all, you can contact us and the details are there. You can email Wendy, who organises the webinars, on that email address, or you can ring in on that phone number. Or if you don't want to actually make contact but just want to go into a little bit more, go to the website which is listed there. There's a lot of more useful information there, and that will also guide you to our YouTube site, which has loads of videos on business growth tools. So that's it for today. Thank you for attending today, and appreciate your concentration on this, because it's not the most easy of subjects for business owners, but hopefully you found it useful, and hopefully there'll be plenty for you to go and take action with. Hopefully see you next time. In the meantime, take care. Thank you.